And welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Scott Kirshner. Scott is actually off this week, but I do have Jeremy Baker, no relation, joining us this week. 419-794-3030 is the phone number. It's 419-794-3030 and online, Americasretirementheadquarters.com. Guys, if we're not already in a recession, and there's been some debate on whether that is the case, a lot of people sense one is coming soon. So how exactly do you go about recession-proofing your retirement savings? Annuity advocate Cheryl Moore of wincantel.com says you can put a portion of your nest egg into an annuity, and that provides a stream of guaranteed income.
If you've put your money into an annuity, you're going to get your money back when you're ready to retire, regardless of what happens with the recession. Now, one thing that might change is your spending power, but there are great annuities that have features in them where you can have increasing income payments, where maybe my paycheck this year is 4% of my annuity's value, but next year maybe it goes up to 6% of my annuity's value. And after that, maybe 8%.
So guys, let's take a deeper dive into this. Is this a strategy that you like? And what actually happens to annuities when the market crashes?
I think it's a great topic for people to become educated about, because I think it's a big area that people don't have a lot of education about. And in fact, some people don't understand how their products work. And so you really need to understand before you invest into any financial vehicle what the pros and cons are. To me, there's no real Swiss Army knife approach when it comes to investing, meaning that there's no one product that's right for everybody's situation. You know, when I was in the military and I went out, I was an electrician, I would go out to a site and, you know, to repair some things, I had the standard tools that I took with me. You know, there's standard tools that people should use, like stocks and bonds, but, you know, sometimes there's other specialty products that you pull into the equation and you can use. And that's where I say looking at all the different financial products that are out there and understanding, you know, what type of specialty product it is, where do you use it, makes a lot of sense. A lot of times you think about it, somebody, if you look at a screw, could I take a hammer and bang it into the wall as a screw? And the answer is you could, but is that the most efficient tool? Financial products are kind of the same way. So when you look at annuities, I think the first thing that an investor needs to do is you need to break down whether the annuity is called an immediate or a deferred annuity. An immediate annuity is where somebody is going to begin taking income right away. That income could be paid as a series of payments over their lifetime. It could be paid for a set period of time, say 5 years. One of the things that, Jeremy, you do as a Social Security claiming strategist is help people, say, bridge the gap. You know, so if they're going to retire, let's say at 65, and if you look at Social Security optimization in their situation, it may make sense to not take income from Social Security until 70. And so this is an example where something like an immediate annuity could help bridge that gap and get them to, you know, maximum potential Social Security benefits. The other option that you have is what is called a deferred annuity. So a deferred annuity doesn't mean that you always can't take money from them. Most annuities have some type of withdrawal provisions. The common approach is, you know, in the industry after the first year, you could take out 10% per year without paying surrender charges. Again, everyone's a little bit different, so you need to understand your contract. But a deferred annuity means you're really deferring it to later in life. And that could be other things that come up later in life when you reach the age of 72 and you have required minimum distributions, or some type of maturity date with the annuity if it's 30 years out. The next is that you would have what is called a fixed annuity. Now, this is an area, Jeremy, that I think a lot of people haven't paid careful attention to, because a lot of the annuities are tied to these interest rates that we're talking about. So we think about inflation and we think about the Federal Reserve raising interest rates, and a lot of times our mind goes to the negative of that. But oftentimes there's a lot of positives that can come out of rising interest rates. And in fact, whether it's a money market account, a bank CD, or a fixed annuity rate, a lot of those rates have gotten much more attractive. We're looking at money market rates now that are, in the upper 2s or 3% range, where, a year ago, we didn't see that at all. Some of the annuity rates that are out there, if you want a fixed rate of return, could be the 3.5 or 4.5, or, even approaching the 5%, again, depending upon your time frame and what the terms are of that contract. And then the third category is what is called an indexed annuity. What an indexed annuity allows you to participate when an underlying index goes up. usually to some type of cap or percentage of it. But when you look at the different annuities, Jeremy, what do you think about the difference and how, annuities can be part of an overall planning approach for somebody, who's looking for a little bit more safety, looking for a little bit more peace of mind when the market crashes?
What I generally like about annuities is, and we're not often allowed to use this word, is the word guaranteed. The annuities that we generally use are guaranteed against loss. That the risk of loss goes on to the insurance company. So as we, right now is essentially the beginning of the month. And there are some folks where I prepare monthly statements for. And when I go on, and I look at their accounts, I know for a fact that an annuity number is not going to go below where it was a year ago or 6 months ago. And generally they can only go up, never go down. I look at that, and then the participation rates and cap rates, there does offer some ability of the account values to go up, but most importantly, especially in today's market, that number can never go down, and that's a key. Having that safe and guaranteed bucket that is guaranteed by a specific product. So that's what I really love about fixed index annuities.
Yeah, I think the word there, if you sum it up, is protection, right? So when you're looking at a fixed or a fixed index annuity, they're investments that are protected against market declines because the investment's not technically in the market. So that's how, somebody can be in one of those type of accounts with a fixed, what the rate of return is going to be for the set period of time that you took it out. With an index, that you have the ability to participate when the markets go up, but are protected against loss. So you have that peace of mind. And, the guarantee is, they talk about the guarantee is only as good as the claims paying ability of the issuing insurance company. So you want to look at what type of an insurance company you're working with, try to work with A-rated companies, know what, the backing of that is, know what the financial health, what the history is. A lot of that is good, helpful information. I guess, for me, like a numbers nerd, things that we're looking into when we're looking at the different choices and, what might be a good offer this month from one company can change from month to month as they compete against each other. And then the third category that's out there is what I would refer to as variable annuities. So oftentimes when I'm doing the shows or presentations or meeting with people, some people will say, well, I don't like annuities. I've heard they're expensive. And when you're thinking about they're expensive, they're oftentimes what I think about variable annuities. So if you're looking at how to protect your money when the market crashes, a variable annuity may not necessarily be the vehicle that accomplishes the most effective method of what you want to get done. It's kind of like, again, taking that screw and banging it into the wall with a hammer. Can it get the job done? Yes. Is it the most efficient manner? So let's break that down. The first word is variable. Variable means it's invested in what is called a sub-account. And a sub-account can be things that have equity or bond or fixed income exposure. And because of that, usually what you see is the underlying value can go up and down within a variable annuity. So if somebody is looking at their statement and they're not feeling good about it because the market's going down, a variable annuity oftentimes can still go down like the market goes down, depend upon how it's invested in the sub-accounts. The annuity part is going back to means it provides something, right? So it can provide some type of guarantee. Variable annuities usually come with like a death benefit guarantee, or in the example as we opened up, an income type guarantee. So an income guarantee will say, if you turn income and you meet this contract agreement, this is what the type of income that this account could provide for the rest of your lifetime. That could be level income, or it could be indexed income where it increases based upon different factors. You can do single life, you can do joint life. And I would say, I agree that I think most people want to lay their head on their pillow at night. And I think for a retiree, outliving their income is a big concern. And I get that. But when you factor up what the costs are of a traditional variable annuity, by the time you add in things like mortality expense ratio, admin fees, sub-account fees, rider cost, those products tend to be very expensive, in my opinion. And those products are the ones that most people really don't understand and how they work. What's kind of been your experience, Jeremy, ultimately when, dealing with variable annuities? And I go back to that. I would say there's not one product that's right or wrong for everybody. In fact, in certain situations, I think there are reasons to have variable annuities. I'll give you one as an example. I have a client. He wanted to invest money into the market, and he just, he couldn't sleep at night knowing that if something ever happened to him, his wife was not taken care of in the event that he passed away. So here's an example where if you put, say, $400,000 directly into the stock market, and the stock market goes down to $200,000, if he passes away, his wife, if she's the named beneficiary, would get whatever the value of that stock market account is. That could be the $200,000 in this example.
Right.
Within the variable annuity, oftentimes it comes with some type of standard death benefit. Now, usually the standard death benefit is the amount of money that you put into it. So again, in this same example of the husband puts $400,000, the economy and the markets crash. He goes out to the mailbox, opens up his statement. It's worth $200,000, drops dead of a heart attack on the front lawn. What that annuity death benefit would do is that would bring his wife back up to whole, meaning that $400,000 initial deposit, that would be a way to get peace of mind. And in addition to that, some of the ways that they can be structured is to provide income, which again can be either single or joint life income. And so it can be a way, if you're looking to ensure some of the outcomes, can be solutions to take a look at it. Again, everybody's situation is different. What do you think?
I think probably the biggest advantage of an annuity is that it provides protection. It's money you can't outlive. I hate to say protection against longevity because that makes it sound, I know Chris has corrected me sort of in the past before about that, using that term. But annuities do have the death benefit. They also have that income you can't outlive. It's, I would look at life insurance would be protection against passing away too soon, and annuities would be protection against living too long. Although living too long is definitely not a negative.
Yeah, it's longevity insurance, and I think that's a good point. So, a lot of people think, oh, what if I die? This is helping answer the question of what if I live? So you may, if you're listening, you may have an annuity. And if you're just scratching your head and you're saying, annuities are a confusing topic, I don't know how they work, the ins and outs of them. This is something that, together here, the Baker Boys have more than 50 years of combined experience taking a look at annuity products. The first thing is going back to education, knowing what you have, knowing the good and the bad, and determining, is this the right vehicle to get you to move forward and know what's different about today. We'd be happy to take a look at your annuity and give you our feedback to give you better understanding of, what vehicle you're driving today.
Is it the right tool that you want for the task at hand? Again, a toolbox should have multiple tools in there. You should be wary of anything that is going to be a Nolan, I don't know if you ever were out in the field and you just had to deal with a Swiss Army knife where, it has all the things on there and it can do them okay, but really having more specialized tools is really what it's all about to make sure that your retirement is ideal as possible. So not all annuities are created equal. They're not necessarily right for everybody, but it could be a valuable part of your retirement strategy, and to see what could work best for you, because at the end of the day, that's what you want, is obviously what's going to be best for you. Give a call, schedule a time to speak with the team at America's Retirement Headquarters. See if an annuity could be a valuable part of your retirement strategy. 419-794-3030, or go online, americasretirementheadquarters.com.